Hello.
But particularly today in such volatile times, people are really worrying about running out of money, particularly people who are saving for their retirement or recently retired. So, big question, how do you make your pension last?
Yeah, I mean, obviously in these sort of times this is particularly important, all the more so that in the very recent past, if you were lucky enough, you had a final salary pension, so you didn't need to worry about it. Alternatively, annuity rates were high enough that, again, you had a guaranteed income and you could even pay for that to be index linked to inflation, to give you some inflation protection. But today, £100,000 of pension would only buy you £3,221 as an index linked annuity.
Not much.
No, it's not much. And even if you take out the index linking, which is not necessarily a good idea if you could potentially live for 30 years in retirement, you'd only get £4,920 a year. 12 years ago, before the financial crisis, you would have got almost 8,000 for that. And before that, it wouldn't have been uncommon to get 12 or 15,000 for that. And bearing in mind, this doesn't allow for inflation, so this is comparing 15,000 with 4,920 in nominal terms, not accounting for inflation. So what you have to do, because so much more responsibility is on you as an individual, as a retiree or a potential retiree, you have to manage your drawdown. And in such a circumstance, there are one or two things that you need to look out for.
Let me guess, pound cost ravaging, yes?
Yes, pound cost ravaging. You may remember that in a recent show we talked about pound cost averaging being your friend as you were accumulating your pension. So, for example...
Good thing.
Yeah, it was a good thing. It really helped you. So, for example, if you were putting £200 into your pension every month, if the markets were weak, that £200 would buy more. And if the markets were strong, you'd be buying less. So on average, you'd be buying more when the market was weak and less when the market was strong. But when you're withdrawing from your pension, the whole thing works in reverse. So for example, in March, the market was very, very weak after being hit by the lockdown and COVID-19 and all the rest of it. If you'd withdrawn money from your stocks and shares, ISA, or your pension, or what have you, would have had to have sold proportionately more to raise, say you wanted £1,000 to live on for that month, than you would have done if the markets were strong. And what this effect is pound cost ravaging. So, and it can be very dangerous because basically, if your pot, or if the market falls early in your retirement, it means your retirement pot can sustain lasting damage. And let me give you a couple of ideas, a couple of examples of how that worked. Money Observer magazine did a recent study. They took somebody with £100,000 in their pension pot, withdrawing £5,000 a year, and looked at where they were 5 years down the line. So if they'd retired in 2007, a year or two before the financial crisis, their £100,000 pot would now be worth £79,561. Whereas if they'd retired 2 years later, after the crisis, their £100,000 would now be worth £153,292, bearing in mind that they've been withdrawing £5,000 a year for 5 years as well. So what this is suggesting is that you do need to take care of your retirement pot, especially when market conditions are tricky.
You can't assume that some fund manager is going to do this for you.
No, not at all. A financial advisor might be able to direct you in the right way, but essentially you do have to take some responsibility for this for yourself.
Yeah.
So basically, what you need to do is take the strain off your retirement pot, especially in the early stages of your retirement. Two ways you can do that. One is withdraw your money at a sustainable rate. Now, in the past, a sustainable rate was always regarded as 4%. There were various studies that suggested 4% made it very, very unlikely that you would run out of money. Today, with interest rates being so much lower, you'd probably be wise to look at least 3.5% and possibly 3% as the withdrawal rate. And the thing about that is also, if you think of your £100,000 pot again, and you were withdrawing £5,000 a year, if you were investing it in a fund that didn't have any return at all, say a deposit account, for example, virtually no return at all, you would run out of money after 20 years. 20 times 5,000 equals £100,000. So to some extent, to actually give your money a chance of lasting long enough, lasting through your retirement, you have to take some measured risk. And Artemis Investments, the fund manager, they calculated that basically if you wanted to withdraw money at 4% per annum from your retirement pot and give yourself a reasonable chance of not running out, I mean, there are no certainties in this, but a reasonable chance of not running out, you would have had to have had a 60% exposure to equities, which is quite high for somebody in retirement. Even to achieve 3.5% would require a 40% exposure to equities. So you can see where this is going, that if you want the safer pot, the sustainable withdrawal rate also falls. So that's important to bear in mind. So the other strategy you could look at is what I call a high risk and a low risk strategy. So you'd have your equities and your equity-like assets, funds and stuff like that, in one pot, and that might even form the substantial part of your pot. But you'd have another pot that was much lower risk, perhaps cash and bonds and what have you. So if you had a situation like March, where the markets were really, really weak, and you still required to take your £1,000 a month or whatever out of the market, in March you would have taken it from your cash and your bonds, simply to give your equities a chance to recover. And sure enough, equities did recover. They had a very good April, May and into June. So they did recover. I mean, that's not guaranteed, but you see what we're getting at. And this is the pound cost ravaging we're talking about. If you are plundering your stock portfolio or your share portfolio at its weakest moment, you are going to have to sell quite a bit to achieve any given sum. And this is the pound cost averaging you need to avoid. So basically, what you need to do is have the flexibility, ideally have the flexibility that if the market is having a hard time, you ideally trim your expenditure just to take allowance for that, not permanently, but over that. Or if you can't do that, or as well as withdraw any cash you need from stocks, from bonds and cash, rather than stocks, to give the stocks a chance to recover. Because we've had an excellent example of that working very, very recently. If you'd been able to lay off selling the stocks in March, you'd have been rewarded in April and May as the market recovered. So I hope you found that useful. If you have, please subscribe, please ring the bell, comment below, especially if you've got ideas for other videos and what have you. But until next week, take care out there.